the situation with these banks is actually so acute. One of them could fall over at any moment. And we're talking not just minor banks, we're talking about global systemically important banks on that GSIB list, of which there's about 30 or so around the world. I mean, Europe's got 5 or 6 of these, I think. And it's a very, very ugly picture, I can tell you.
Welcome back to Liberty and Finance. We have a returning guest who's wildly popular with our viewers. This is Alasdair Macleod, the head of research at goldmoney.com. And he's joining us this Wednesday, December 16, 2020. Alasdair, thank you for squeezing us in your schedule.
That is my pleasure.
We've wanted to have you back on for an end-of-year look back and a look ahead, partly because that's what we do every year, but also because you really made a big splash at the beginning of Q3 with a prediction that we were going to see a banking crisis in July at that time and a fiat crisis by the end of the year. And in more recent interviews that you've been giving, you've been talking about evidence that in fact these things are happening right before our eyes, but a lot of the crumbs and pieces are falling and being swept under the rug in various ways. We want to get back to that very quickly, but we couldn't help but notice your tweet today about a breakout in the silver price and also in cryptos. Can you talk to us about what you're seeing and why you think it's significant?
Well, it is interesting. I mean, silver has been sort of hit pretty bad. Its performance has been better than gold, quite a lot better than gold, since the Fed declared hyperinflation back on the 23rd of March. And I think that having held up so well, it seems that it's now broken out of that consolidation trend on the upside. Very, very early days. And of course, these breakouts sometimes are false. So this is not something that, you sort of immediately cheer and think, way, we're off to the moon. But silver, I think, is very underpriced in the current financial environment. I mean, with the Fed printing money without any limitation whatsoever, and with further obligations down the road, which will be satisfied by printing money, I would say that the precious metals are basically underpriced. And they're underpriced because people actually, in this fiat world, they don't understand what's happening to fiat money. There is a sort of cadre of people who have an inkling, and I don't think their education is complete. Their education is basically, we know that the Fed prints money, and we know that they print it at a greater rate than, say, Bitcoin, which is limited in terms of how many Bitcoin there are going to be in 2021 or whatever it is. And therefore, on that basis, it's a supply situation. You sell dollars, buy Bitcoin. Simple argument. And of course, when the price starts running, you think, whoa, we're off to the races here. And of course, the institutions have not been involved with it at all. And they're now looking at this relative supply thing between the dollar and Bitcoin. And they're all getting on board. I mean, almost every day we hear there's some billionaire or some hedge fund with putting in another 100 billion or whatever. Now, I mean, where's the Bitcoin going to come from it? And so you get analysts who say, they look at this and they say, I can't see there's anything going to stop Bitcoin going to over $130,000, or they've just picked these figures out of the air or something. I don't know, but you can see the attraction of that situation. And indeed, on this very day, Bitcoin broke out above $20,000, which has been a long, long, long time resistance point. It has finally done it. And for all I know, I mean, it could very quickly go up to $30,000 because you've got this sort of ridiculous situation where there is really extremely restricted supply of Bitcoin and unlimited supply of dollars. So, it's likely to happen. But people aren't thinking it through. They're not really thinking through to the extent that they're looking at the dollar. They're just looking at the Bitcoin and they're saying, gosh, this is marvelous. We can make lots and lots of money. just go and buy Bitcoin. That is the argument that people are pursuing. They're just not looking at the fundamental problem underneath it all. And the fundamental problem underneath it all, of course, is the dollar. And so attractive is the speculation in Bitcoin, Ether, whatever, that gold in particular has been left behind. And we're told, well, the reason gold's been left behind is that everybody's buying Bitcoin instead of gold. Well, at the retail level, there is a certain amount of that going on. But if you look at the relative performance of the two, gold was consolidating at the same time as Bitcoin. The volatility in Bitcoin means that you probably lost more money in that over that period than in gold. I mean, obviously, it depends when what point you look at this. But I see no evidence that people have moved, if you like, to punt in Bitcoin and have stopped punting in gold, other than that very, very shallow level. But we understand that fiat money is going down the tubes. This is the important point, if you like. And so in this sense, it's interesting to see silver, which is a lot more volatile than gold, which has been following, let's say, a bit more of a commodity track than a monetary track, has now broken out of the downtrend and presumably has got considerably further to go, having had a nice long consolidation period. So that's roughly where we are, and it's an interesting juncture.
You mentioned the difference in price performance of these dollar alternatives. Silver, for example, people talk about, when you're talking in terms of dollars, you're talking about nominal price and whether things have reached their nominal highs. We had, as you've talked about, John Williams from shadowstats.com on here reminding us about the importance to understand the inflation adjusted. So when people talk about, for example, silver hitting 50 back in 1980 and then again in 2011, these aren't the same 50s anymore. So by his reckoning, we would be significantly adjusted today for much higher, even to reach a real match to those previous resistance points. And so how does that play in as you look at it to the value proposition of metals at this point, given the inflation picture over time?
Well, I agree with that statement completely. But we live in a world which is driven by fiat currencies. Anybody investing in the stock market buys a stock with a view to selling it at a profit in, guess what, dollars. Or over here it would be in pounds, or in Europe it would be in euros. In other words, the value that we are actually looking at, the subjective value, is entirely in what we buy. And I'm bound to say that the vast majority of people who buy physical gold look at it exactly the same way. They look at it in that sense as an investment, not as, if you like, sound money, which you should own to protect yourself. Now, until people actually look at it as sound money rather than a punt, then what is going to matter is the nominal value of the dollars which you bought it at and what you expect to sell it at. So in a sense, I mean, I agree entirely with the change in values due to the underreporting of inflation. But with all the sort of fixed value in a transaction observed in the currency, I don't think it really matters in terms of pricing, because that's not what people are looking at. What people are looking at is, I bought it at X and I'm going to sell it at X plus 10% or 20% or whatever it might be. So interesting point. I mean, I do agree. And I think that an observation I would make is that the people who will get this very wrong are chartists, because they look at nominal levels the whole time. I mean, last time silver was stopped at $50 overnight in the middle of a holiday in the Far East and a holiday in America, which allowed them to bash the market and get the price down and take all the speculation out of it. Okay, that's absolutely great. But, so when it gets up to 50 on the charts, they'll all say, it's time to consolidate or sell or whatever. Could be a big mistake. And we did see this very recently in Bitcoin. I mean, I was fascinated to see that when it ran up to about $19,500, $19,700, something like that, about 3 or 4 weeks ago. And then it sort of it drifted back to sort of below $18,000. You had a number of people coming out just looking at these nominal levels and effectively saying, this reaction is going to take it down to 14,000. So guess what happened? Anyone who took that advice or listened to any chartist who said that, they're now faced with the hurdle on this wonderful thing, which they know is going to the moon. They didn't buy it, they sold it, they're out of it. And I think in a sense, that's actually defines a bull market, that it sort of continues to climb and nobody actually gets into it. When they're all into it, that's the point where you sell it. And we've seen this absolute classic behavior in Bitcoin. And I suspect it will come through in gold, and it'll come through in gold really when people begin to understand the extra problems that the Fed has and will have to print money for, because it's not going to stop with wave 2 in COVID. And that's probably a subject we should continue with.
I really think we should dig into that, because you've talked with us in the past about the actions that the Fed has backed themselves into being able to take or needing to take are in and of themselves further toxic to the underlying strength of the currency and so on. So can you go ahead and get us into that? What are these additional problems that the Fed faces, and how will their likely attempts to remedy those problems, create additional bigger problems?
Right. Well, this is something I'm actually going to be publishing in an article tomorrow. So I'm going to try and give you an outline as to what the problem is. It is slightly complex, so your viewers might like to jump onto the Gold Money website, sort of late afternoon Eastern Standard Time. It should be published then. Basically, the bones of the problem we've seen in some statistics recently. I don't know how many people are aware of it, but if you look at the M1 statistic, which is the narrow definition of money supply, in the last, I think it was over November, it jumped by over 11.5%. Now, this is a massive, massive leap, just in a very short period of time. The sort of annualized expansion of M1 works out at something like 360%. I mean, so when I called this a hyperinflationary situation a bit over a month ago, this is actually now appears to be coming true. Mm-hmm. When you dig down into the numbers, what we're looking at here is the deposit side of bank balance sheets, in effect. It's because M1 is checking accounts, it's cash, it's that sort of thing. Checking accounts at the banks, and that is the majority of it. Also money funds and so on. Very short-term stuff. There is another statistic called M2 money supply, which includes savings deposits. And that is, if you like, a very large element of it. There are various other bits and pieces that go into it, but basically it is savings deposits. The interesting thing is that when you look at what's been happening between savings deposits and checking accounts, people have been moving money out of, this was in November, out of savings deposits into checking accounts. And checking accounts have been growing at a very rapid rate. And that has been the engine, if you like, in the growth of M1. So what is going on? What we are seeing on the deposit side of the bank's balance sheets, in other words, its liabilities to deposit holders, is that depositors, and these are not the people, the small man who is guaranteed by the FDIC that he will get paid out if the banks go bust. We're talking about the bigger money. We're talking about over $750,000 type deposits, the deposits that are not protected in the case of banks going under. They appear to be moving their funds from being tied into term loans to the banks into instant access, so they can take it out any moment. Why are they doing that? They're doing that because they're probably worried about the banking system. No, there are elements of that which I'll describe in a moment. But predominantly, I think what they're doing is they're looking at rising equity prices. They're looking at cryptocurrencies. They're looking at commodities. They're looking at things like gold. And basically, they're looking at how can I get out of the systemic risk in the banking system. And this does not mean moving money from one bank to another bank, because that doesn't stop your systemic risk. So perhaps what we're seeing is a growing realization that the situation is not actually very good and is beginning to deteriorate. Now, why is this? If you want to try and get an approximation of what's going on with the banks, then what we're interested in is what they're doing in terms of bank lending. Now, so how do we get to that? There are a few statistics around which you can pick up, but the best way of looking at bank lending, and this covers shadow banking, whatever, pretty much, is to get M2, subtract M1 from it, and you end up with the difference. Now, the interesting thing is that there's been a very sharp fall in the equivalent of bank lending when you look at it from the deposit side of the bank balance sheets. And so we now want to see, why is it that these banks are getting concerned? Now, we've talked about this before. There is a cycle of bank credit, and it starts off with bankers being pretty cautious in their lending. As the situation progresses and the economy doesn't fall over or bankruptcies don't rise or whatever it is, they get just a little bit more confident, and so they begin to lend to their favored customers. And that lending spreads, and it gets to the point where they're happy with where the economy is going. They're happy with their loan book. They're prepared to expand it more, and they will even compete. They will even cut the rates to get the business they want in. And it then goes a bit further, and the whole thing gets overblown. And before you know where you are, banks have moved from, say, 5 or 6 times their capital in terms of balance sheet total to 10, 12. Maybe 14 times. Now, you can imagine that if you've got a balance sheet like that, and you see, oh my goodness, this is not quite right, there are going to be losses if I'm not very careful. If you lose $1, it's going to be magnified in terms of the capital to something between $10 and $15, depending on your gearing. So the gearing works in reverse. Absolutely. And it just kills banks. It really does. And this is why bank credit contraction is such an important thing to watch. Anyway, what's doing it? The other thing that's come out is that we know that there has been massive disruption of container shipments. I'm talking logistics here. Now, the reason that logistics are important is that logistics basically are the supply chain for everybody. And that supply chain, when it gets gummed up by containers being in the wrong place and all the rest of it, basically means that products are not getting to the market, components are not getting to manufacturers as part of the assembly process, which it ends up being assembled for the consumer. And the result is that the payment flows that are involved with this, which go the other way, are equally disrupted. Now, if you look at the equivalent statistic which measures these, this is something called gross output, which is all the steps in the manufacturing process. So company A makes components for company B. It delivers those components. Those components are then paid for by company B to company A. Company B continues to assemble something which becomes part of something that sells on to company C, and so on and so forth. So you get the components going one way and the payments going the other way. Now back to the containers. The containers around the world have basically stopped moving. They're all in the wrong place. And the reason for this is, going way back to the beginning of this problem. In China, they had a problem because they didn't have the delivery drivers taking containers to the ports. So there were ships standing idle there. Eventually, that was sorted out as China moved off from its COVID lockdowns into, sort of encouraging businesses to get going. It doesn't matter whether you've still got COVID. We're going to get this economy going was very much their attitude. So you then ended up with containers being shipped, say, to the Pacific seaboard in America, places like Los Angeles and San Francisco and so on and so forth. Now, that then had a problem because you didn't have the delivery drivers to take all the stuff away, because you had COVID. And so you can see how the thing begins to foul up. Add into that another problem, and that is that what we really demanded, if you like, as consumers and the people who produce things for us, the manufacturers, what they really demanded has changed completely as a result of COVID. So you've got containers with stuff which is not wanted. You've got non-delivery of things that you really do want. So you can see how it's all beginning to foul up. And in Asia, they reckon that the rollovers, this is another factor, because if you fail to get your container on a ship, let's say from Shanghai to, well, wherever, let's say Valparaiso or somewhere like that, then if it fails to go on that, it's what they call a rollover. In other words, it's then marked to go on the next available ship. But with this chaos, the rollover probably doesn't happen. Now think what this does to the payment chains. The supply chains are being screwed so badly that you just don't know as a manufacturer when the stuff, your components, are going to come from, say, China or from India or wherever it might be, or even Germany. You don't know when they are going to arrive. You don't even know where they are. So how can you finance this situation? Now, the reason that this is so important is that we had this problem way back in March. It was evident then, and the banking community basically rallied round the Fed because COVID was going to finish in a few months and then we would all return to normal. That story has got so worn out that now bankers are beginning to think this is a lot more serious. So they have reduced their lending very, very sharply in the last 6 weeks or so and cut back. Now, the cost to industry has been very substantial. I mean, gross output has fallen by roughly $4 trillion between the end of last year and the middle of this year. So we've still got to see what the last 6 months have done, but they're going to be no better. So this contraction in gross output gives you a rough idea of the payment disruption amongst the supply chains. We're talking enormous figures here. Now, so how is this going to be resolved? Well, the Fed has a duty to do two things. First of all, to ensure the banks don't fall over. And secondly, to ensure that the economy doesn't fall over. They're already financing the government deficit, which is 2/3 financed by monetary inflation and 1/3 by revenue. They have now got the additional problem of an economy that is falling over because the supply chain is not working. The payments across the supply chain are still not working, and banks can no longer support this situation, which is why they are reducing the level of bank credit. So the Fed has to make up for all that. You can have people saying, well, there's a very deflationary situation. Yeah, it is deflationary. But do you think the Fed is actually going to, and the US government is actually just going to sit there and let deflation kill the economy? No, that certainly is not going to happen. They are going to make however much money it takes in order to get that going. So I see two things. I see banks in trouble. In order to create balance sheet space, if they were even willing to do it, the only way they can do that is by increasing their equity base. And that means probably doubling, tripling the amount of shareholder equity in the balance sheet. The problem there is that most banks in America, I mean, it's not so bad in America, but I can tell you it's considerably worse elsewhere. Most banks' market cap is below their balance sheet book value. So, you're diluting your shareholders horribly. I mean, the only way you can do this is in a crisis. We would say to the shareholders, look, the alternative is we shut up shop and you get nothing. So you have to accept a dilution, if you like. That is the reality of where banks are in terms of the size of their balance sheet relative to their market caps. So that, if you like, is the first thing I see. I can see that the crisis which is arising from a contraction of bank credit, while at the same time the level of bankruptcies in the economy are increasing and increasing and increasing, leads to some sort of resolution of this banking crisis will have to come about. Either that or the banks go bust. But the Fed is there to rescue the banks. That's one of the reasons it was set up. So they will rescue the banks. How do they rescue it? They will rescue it presumably by injecting an awful lot of new capital so that the Fed or the Treasury or the government ends up owning a huge, great proportion of its banking system. That's one possibility. But at the end of the day, somehow that money's got to get from the Fed into the basic economy, into the supply chains, and also into the local businesses around. Because, I mean, if you look at businesses in a typical country, you will see that sort of it's a Pareto, 80% is sort of local, small and medium-sized businesses, and the other 20% are the businesses which are typically listed on a stock exchange and do international trade. So, you know, at the moment, we've just been talking about supply chains, if you like, which are predominantly big business. They have got to get not only that resolved, but they also have to go even deeper into the economy. What we're seeing, DK, is a financial mess, which, quite frankly, is beyond the ability of any central bank to resolve it, unless they're prepared to print and unless they're prepared to see their currency going down. Because you've got the other element of this. You've got foreigners, foreign ownership of dollar assets, and I'm talking financial assets. I'm not talking about physical property or things like that. You're looking at around about, I think it's 28.5 trillion on the Treasury tick figures, which includes a bit over 6 trillion of deposits in the banking system. Why is the dollar so weak against other currencies? Because these guys are leaving the sinking ship. And it tells me that the dollar, which at the moment, the trade weighted, looking at my screen here, is about 90.41, down from 103 or something since March. I mean, you can see that any foreigner holding dollars or holding fixed interest in dollars, like US treasuries and agency debt and corporate debt and things like that, after interest being paid on that debt, they are losing. They are losing big time. And so they are liquidating their positions, their fixed interest positions. They're not liquidating their equity positions on balance yet. But you can see that if you get an asset, if you like, a sort of collapse in bond prices, a further collapse in bond prices, a rise in bond yields, which is bound to happen. It must happen. It's not, the Fed can't sit on rates forever. The only reason that rates are where they are is because the Fed is suppressing them. The natural rate is higher, and it's considerably higher than where we are because of what is happening to the dollar and because there is so much more money being printed. So you can see that the foreigners have every incentive to sell the dollar down to considerably below the current levels. Why? Because the only thing that will stop them is a real hike in interest rates. But if you get a hike in interest rates, you kill other financial markets in the US. And the other thing you do is you kill government finances. So, this is a situation which is only going to deteriorate next year. You're going to get these conflicts. And it seems to me that in recent weeks, the fact that M1 money supply has suddenly had this jump tells me that the smart money, the big deposit money in the banks, and these guys are smart. I mean, if you've got 10, 15, $20 million on deposit in a bank, you are financially literate, or at least you're being advised by someone who's financially literate, and you're being advised by someone who's got a pretty good idea of what's going on in the system. So what we have seen, I think, with this, it is almost a signal that things are beginning to go horribly wrong in the banking system. I hope I'm wrong, but I think that the sensible thing to do is to take note and be cautious accordingly.
I just wanted to underscore one thing that I hope I'm understanding correctly, and that is the spike in the M1 currency supply is, in your view, potentially indicative of basically a crowding in the exit doorway of the banking system.
Yeah, I can say a bit more about that. I mean, basically, what's happening is that money is accumulating on checking accounts. It's moved over, so far as we can see, to a degree from savings accounts. So to describe it as money which is sort of accumulating, ready to jump out, is basically correct. But I think at this stage, people are not thinking so much about the collapse of the dollar. What they're thinking is that we need to get out of dollars into financial assets. Now, whether that's stocks, in other words, this would suggest there is a run, a further run up maybe in stocks. I mean, I don't know whether it'll happen, but you can see the other assets, commodities in particular, big trade there. And, we're seeing that silver is beginning to break out. I don't know. I haven't looked at the other commodities like copper and so on and so forth to see whether they're going to break out from these levels, but I wouldn't be surprised if they are. Gold has been sort of left curiously quiet in this, which tells me that the mainstream, if you like, are not yet thinking in terms of the relationship between sound money and unsound money. I don't know they even know that there is a difference or what that difference is. So there is an education process which these guys are going to learn the hard way, because one of these days gold I think is going to take off. It's not so much gold taking off, it's the dollar going down. Mm-hmm. And it's only people who understand that point who will get the message. So there's an education process that's going to happen. The accumulation of cash, if you like, in M1, I think is a very important indicator as to what is going on. And to a degree, it is one of the things that has reduced the bank lending figure when you look at it from the deposit side, because coming out of savings accounts are part of M2. They are not included in M1. So if you move money out of a savings account into a checking account, you are suppressing M2 and increasing M1. There is an element of that in it, but in the sense of the sort of the big shifts that are happening, this is only part of the of the scene, and it is the smaller part, if you like, of the big picture. The big picture being what is going on with the supply chains.
We have a follow-up here on your prediction in third quarter that we were on the imminent cusp of a banking crisis. Tony asks, why has there been no banking crisis? You stated 5 months ago you expected to see a banking crisis within days, if not weeks. Not trying to pin you down, but do you think the ECB or the Federal Reserve stepped in without saying anything and saved a bank?
Well, the answer, partly. I mean, I accept the criticism because I'm usually quite early in my predictions, which means that I don't encourage people to trade, if you like, on my predictions, but what I do encourage them to do is to take note and make their own analysis, given that hopefully I have given them some information which is worthwhile. But the other thing I would say is that the Fed did step in and protect the banks back in September 2019 when the repo market blew up. Mm-hmm. Now, that quite clearly was protecting the banks. The banks had run out of balance sheet space. By that, I mean they hadn't sufficient capital to continue lending at the rate at which they were lending. And they were being driven into the repo market in order to balance their books. So, I mean, it happened from there. I haven't said anything about what's going on in the Target 2 system because, we're focusing on the dollar. But you've only just got to look at what's going on in the Eurozone to see that is going to collapse. I mean, the ECB produced out of their magic tree another 500 billion euros to lend into the banks, and they were going to do that basically through QE, and their QE was to buy Italian debt at negative interest rates. Would you believe? Spanish debt at zero interest rates. I mean, this is just complete rigging of markets. To a ridiculous degree. And that's going to fail. I mean, anyone who looks into Target 2 can see that it's absolutely full of bad debts. And I did explain this in an article some time ago. And as well as that, you've now got bad debts in the local banks, all accumulating as a result of COVID. I mean, you don't even need to look at the bigger picture. I mean, COVID is killing the Italian economy, the Spanish economy, the French economy, even the German economy. They are all being killed by this COVID thing. Now, this means, as far as the banks are concerned, is escalating bad debts. Simple as that. And the highest gearing that we have in terms of the relationship between assets and market cap of all the big banks, that highest gearing is in the Eurozone. I mean, there are so many major banks which basically are beyond the pale. I mean, it's just absolutely extraordinary that is going to fall over. I mean, I'm very confident of that prediction. And I think that it could be that something else triggers it. I mean, something else like, this supply chain.
Mm-hmm. Non-payments because of the supply chain.
When the banks run into trouble, it's always the weakest banks that collapse first. So, you're looking at a bank here and you think, this bank has got problems, da, 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 da. And then you find, whoops, something's fallen over there, and then you've got the ripple effect. You've got the Creditanstalt problem of, I think it was 1932, when the French removed their support of the Austrian bank, Creditanstalt Bank, which itself was a merger of failing banks. And that precipitated a banking crisis throughout Europe. It's difficult to predict where the thing actually starts falling over, but I can see things that are going to make it fall over.
That plays into a question that we had a viewer who asked, we talked about what signs do you see? He says, Jack Nichols asked, what signs should we look for when the final reset is near? You're talking about things that are in plain view for those who have the eyes to see them as you do. Maybe you want to you've given us quite a litany of those concerns you've got, but in the vein of what signs should we look for, sounds like expect something to fall down behind you when you're looking over the other direction, is what you just said.
Yes, I think certainly expect the unexpected. But I think we've covered this subject in terms of the problems that the banks face and also the signs that they're beginning to substantially reduce their balance sheets, and that is going to create problems which you can work out for yourself from that.
If just the high points for those who haven't heard that, I listened to an interview you did on Palisade Radio where you went into some detail about the Target 2 system in Europe, and you touched on it briefly on an interview with us in the past. But just so people understand the biggest headline concepts there, when you say we are already seeing a banking crisis in Europe, but it's being swept under the rug, can you give people at least the key concepts they need to understand about that?
Yeah, yes. I mean, I'll describe what the problem is with Target 2. Local regulators, I mean, we had this situation particularly in Italy. Local regulators determine what is a non-performing loan and what is a performing loan, in effect. Now, this is in connivance with the banks. The reason this is important is that if you can say that loans are performing, then you can bundle them up as collateral for the local central bank, which in this case is the Banca d'Italia. So what the Banca d'Italia then does, it's got this bunch of non-performing loans which the local regulator has said are performing on its balance sheet, okay? And it's got it in the Target 2 system. So that's the first problem. The second problem in all this is that we've now got a new wave of non-performing loans arising in the banking system. And so what are they going to do with that? I mean, can they hide it again? Well, they could try, I suppose. But, you consider the position of a bank, of a central bank, a regional central bank like the Bundesbank. They are owed 1.2 trillion euros through the Target system. Now, can they blow the whistle on this? No, they can't, because the moment the Target 2 system falls over, then they don't get their 1.2 trillion or whatever is left over out of all the bad debts and all the rest of it. They are on the hook for 400 billion, which is their share of the capital key. Now, the capital key is just a fancy phrase for saying their shareholding in the ECB, because Target 2 falls over, ECB basically needs money in order to survive. And it will need at least as much money as the target 2 imbalances. So you can see that, if you're on the board of the Bundesbank, you know what's going on. You don't like it. You want to stop it, but you can't, because the moment you stop it, you find that you lose your balance sheet bit of 1.2 trillion, replaced by a liability of 400. Now, what does that do to your balance sheet? You bust. So you can see that this target 2 situation is extremely concerning. And it's only a matter of time before it blows. Now, whether it's triggered by a bank, maybe one of the major French banks, which are just incredibly geared and is rated in the market at sort of option money on its survival, I won't tell you which one it is, because that's just being a bit too definite. But the situation with these banks is actually so acute. One of them could fall over at any moment. And we're talking not just minor banks, we're talking about global systemically important banks on that GSIB list, of which there's about 30 or so around the world. I mean, Europe's got 5 or 6 of these, I think. And it's a very, very ugly picture, I can tell you.
Well, there's something underpinning this that's very concerning besides just the numbers, and that's this systemically institutionalized dishonesty. You mentioned at the local level, you have regulators that are in cahoots with the bank owners to certify toxic debt as an asset, and then you've got at the regional level people who know about it but don't want to blow the whistle on it because they're afraid the whole house of cards tumbling down. It just rings true to the gut, the gnawing feeling in ordinary people's gut that have had them listening to reluctant preppers since 2013, talking about there's something rotten here, and we don't, and the cheap seats, we don't know what to do about it. We don't know where it is, but it just doesn't seem right. Is that your view of the banking and financial world at every level? Is this institutionalized dishonesty that everybody knows, everyone involved knows that it's all based on a house of cards of lies, but nobody wants to be the one to blow the whistle?
Yeah, basically that's true. I mean, I would put it slightly differently. Banks game the system. I mean, if you got regulations, and the first thing the legal department look at is how can we get around this regulation? That's a fact of life. I'm sure we all understand that if we think about it. But also the regulators have got an interest in gaming the bigger system, like Basel III, all that sort of stuff. What they're interested in basically is turning a blind eye to the problems that the banks have, and they haven't resolved, in this case, from the time of the Lehman crisis. And when it comes to looking at how the market rates a bank, no, can't possibly do that. What really matters is balance sheet equity is this, and the assets are this, and the quality of the loans is this, and And so, but the banks, I mean, they're gaming the system. They game the system considerably more than the regulators understand. But the point is that the regulators do not have an interest in exposing this. They would rather cover it up. And we've seen this with stress testing. I haven't really looked at stress testing in America very closely, but I can tell you that in Europe and in the UK, the stress tests have been absolutely risible. I mean, it's just complete nonsense. They are designed so as to not show any problems. It really is that extraordinary. So, I mean, but as a regulator or as a government or a central bank or whatever, you just want to sit on this stuff. You don't want to expose it. I mean, if a bank is really rotten, then, the stress test will probably show that they need a bit more capital. Oh, well, what a surprise. But they won't look at what the market is saying. The market is saying in many of these cases that the equity in the bank is worth 20 cents on the dollar, no more than that. Now, if you have got a market saying, with a collective opinion that that is the worth of the bank, then basically all it's doing is it's saying we will buy an option on the shares on the value of the bank for 20%, no more than that, of the equity value. And, that to me is a sign of a bank which basically is insolvent and can only survive with an awful lot of help and connivance of the regulators. And that's where we are, I'm afraid, with an awful lot of Europe. I mean, you'll have seen, the ins and outs of Deutsche Bank, management coming, management going, fines for this, fines for that, terrible results, whole thing being written down and all the rest of it. It's been a very, very serious situation for that bank. How they've survived, I think they've survived with an awful lot of forbearance from the regulator. And the same is true of Dresdner Bank. I mean, Dresdner Bank isn't even a GSIB. This is, it is the shadow of what it really was. I mean, sorry, not Dresdner, it's Commerzbank. Commerzbank took over Dresdner Bank. I mean, we're talking about two major banks. What they did basically was they consolidated a bank which was in trouble, which was Commerzbank, with a better bank, which was Dresdner Bank. And now Dresdner Bank's being, dragged down. They've been dragged down to the point where these two major German banks are not even GSIBs. It's too small in combined form, even to be in that category. So the private banks, which are how these are described, as opposed to the Länder banks and all the rest of it, these private banks in Germany, you would think with the best economy in Europe, that the banks would be in the best position of all the banks in Europe. Yet, they are on the verge of insolvency and bankruptcy.
In the face of all of these concerns, a number of our viewers have turned to precious metals as a respite or a safe haven. And you mentioned earlier, way back earlier, about you don't just watch what the small depositors are doing, you look what the big depositors are doing. Well, I guess the ultimate of that might be the Basel III move by the central banks of the world to say declare gold as a tier 1 asset back in summer of 19. We have a question from Ben Arthur here who says, Alasdair, given silver's history as money and the fact that it has so many uses as an industrial metal, coupled with the fact that it's mined at a ratio close to 10 to 1 with gold, why do you see the gold-silver ratio so disconnected?
Well, the answer to that is very simple, and that is that silver is not being priced as money at all. Gold is being priced as money, and then we could probably debate for some time the extent to which that pricing is correct or incorrect. But in the case of silver, it is not priced as money, and this first happened when Germany went on to the gold standard in, I think it was 1873, 72, 73. The reason it went on, it was on a silver standard, and the reason it went on to a gold standard was it won the Franco-Prussian War, and it took reparations from France in gold. So it then was able to go on to a gold standard. But the moment it did that, the price of silver just literally collapsed. Why? Because its value as money is far higher than its value as an industrial metal. The situation we have today is increasing concern about the future of fiat currencies and the inevitability of their eventual replacement. We believe, now cryptocurrency people would argue the opposite way, but again, this is a different debate, which I'm not going to get into. But we believe that, and we have reason to believe that gold and silver will return to be either as money or to back money somehow once the current system of unbacked fiat currencies fails. And we are looking, and this is what we've been talking about the process of the failure of these fiat currencies. So we know that in the past, there have effectively been three metals which have been used as money. Lowest in the ranking is copper. Nobody uses that anymore. It's now purely an industrial metal, and I would have thought would always be so. Silver and gold. Now, if we had a situation where gold returned as money proper and silver returned as money proper, then the ratio of silver to gold will be in the order of 15, maybe 12 ounces to 1 ounce of gold. The problem we have is that what we've got to do is we've got to look at the situation after the collapse of money. The central banks, I know we don't want this to happen, but the central banks are still going to be there. They're going to try and reorganize things. Now, assuming that they have learned a lesson, and that is a big assumption, then they will back their currencies with the only thing they have got, and that is gold. So at that stage, we've got to think, where does that leave silver? I think that silver will not return as money. But that's not where we are at the moment. Where we are at the moment is we're seeing the destruction of fiat paper currencies. And silver, if you like, has the potential to return to money. So as we see the gold price rise, we're going to see at the same time, or I would expect to see at the same time, the gold-silver ratio fall, which basically means that, at the moment, the gold-silver ratio is 74.3. Okay, I would think that could easily get down to something like 40 and possibly 30 in that collapse scenario. So there is a lot to play for. If you really want to maximize your sound money, then you could consider a strategy of buying silver as part of that, with a view to selling silver for gold once that ratio gets down to that sort of level. You will end up buying a lot more gold if you do that, and that strategy is successful. So that's the context I would look at in silver. What I don't see is a situation where silver is going to return as money. If we're going to have central banks realizing that the game is over and they have got to peg their currency to something, then they're going to do it to gold because they don't have silver.
If people want to follow your work, you've referred both into articles that are upcoming as well as ones you've written recently and published recently. Where can people find all of those articles?
Goldmoney.com and hit the research button. Under that, you'll see insights. And I publish an insight every Thursday. And as I say, it's usually up on the website sort of late afternoon EST. And on the Friday, I also do a precious metals market report, which your viewers might find interesting as well.
I'm sure they would. Folks, if you want to make sure that you get all of Alasdair's links and notes, as well as all of our guests, and stay in touch with us so that we can reach you in case we need to move to a different platform, which dozens of our compatriot independent media platforms have had to do in the last few months, make sure you go to libertyandfinance.com. Over in the left-hand side, put in your name and email address. We'll get you on our all free email newsletter so that you can keep track of us and we can reach out to you. We've been speaking with Alasdair Macleod. He's the head of research at goldmoney.com. And Alasdair, on behalf of all of our viewers, just grateful for your presence here on Liberty and Finance.
Thank you for asking me, DK.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today. To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com. Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.